Welcome to this WTR Small-Cap Spotlight Flashcast. I'm your host, Tim Gerdeman, Vice Chair and Co-Founder and Chief Marketing Officer of Water Tower Research. In today's Flashcast podcast episode, I'm being joined by my friend, fellow WTR co-founder and CEO, Shawn Severson, to discuss the recent rotation into small-cap stocks after a very long drought marked by share price underperformance for many years. Good morning, Shawn.
Morning, Tim. Great to be here.
Shawn, your recent commentaries point to an inflection point for small cap stocks after years of underperformance. Can you walk us through the key drivers behind this rotation, and why do you think that this might finally be the time for small caps to shine?
A great question, Tim. I think a lot of it focuses on interest rates, and there's always been a correlation between interest rates being lowered and small cap stocks doing better. And obviously, we've been a very volatile interest rate environment for quite some time. The idea that the market consensus thinking rates are going lower has brought some activity back into small cap. There are also things that are benefiting, like onshoring, which also helps domestically focused companies, many of which are small cap companies. So we've had a confluence of things that have gotten some attention back on small cap after, as you mentioned, a very long drought. But certainly looks like time to shine, at least over the short term. I think there are things that have to be considered about how long this can be sustained, but it's gotten the attention. The rotation has started to happen, so good time for small cap stocks.
Yes, definitely a welcome change. So you have noted that small cap investing needs to be approached from a stock picking perspective, which I completely concur with. Please walk our audience through why this is the case in this very diverse and oftentimes volatile small cap universe.
Well, I think you can't depend on sector rotation and money flows like you can in some of the larger cap, like being the S&P or the triple Qs or things like that. For example, the total market cap of the S&P 500, is 56, 57 trillion. Total market cap of the Russell 2000 is around 2.7. So you can see there just isn't enough liquidity for large money flows to come in. So first of all, you can't get massive amounts of institutional money and money flows going into it. It just doesn't exist in terms of the liquidity opportunity. So what that means is you really have to start looking at stock picking, and you make more concentrated bets in small cap than you do in buying the market isn't really a good strategy here. And there are a couple things to consider there. First of all, 40, 45%, depending on who you listen to, of the the Russell 2000 have negative earnings. So there are a lot of companies that don't make money in there. You're talking about smaller companies, higher concentrated risk. So fundamental research really becomes the basis for how you invest in small cap stocks. And I think that if you look at diversity and how you figure out your positioning, obviously there are sectors that benefit in this market. Looking at lower interest rates, financials are going to benefit, for example. But what that means is even amongst the financials, you're going to have to figure out, regional exposures and commercial versus residential exposure. Lots of things that go into it that require the small cap investor to pay close attention and be a stock picker, not to mention the need for capital, which we'll probably discuss a little bit. But many of these small cap companies do need funding. They have to go back to the capital markets. As an investor, you need to understand that clearly.
Yeah, I was going to say the balance sheet composition from company to company is quite wide. So you've recently highlighted the Fed's expected rate cuts and improved capital access as pivotal for small cap growth. How do you see monetary policy shaping the next phase of this small cap rally, and which types of companies likely stand to benefit from this?
Well, it's a critical point to discuss because there are two types of companies, if you want to call it that, in the Russell and in general, and those that make money and don't need to come back to the capital markets. People call them higher quality, but I don't necessarily know they're all quality. You're talking about high growth versus maybe some more mature businesses and industries. But the point being is that they don't need to go to the market. So those companies have been getting the first bid here and starting to do better as interest rates come down, and especially those companies in that mix that have debt. Because remember, a large chunk of small cap companies have floating rate debt, so lower interest rates lowers their interest costs. improves their cash flow and balance sheet. But investors have been looking first and foremost at those companies that are making money and are profitable. Underneath that, like I mentioned before, 45% of those companies have negative earnings. That means they consume capital. And by the fact that they need capital, they're going to need access to the capital markets to continue to grow. And there's some important considerations. You look at growth companies that need money. Is it keep the lights on money, or is it grow the business money? And as an investor, to your previous question, you better know the difference when you're looking at these small cap companies and making investments. So I think really the first to benefit will be those companies that have healthier balance sheets, that may not be the super high growth names, but that investors are confident in, and call it quality, call it what you want. And then underneath that will be a lift for those companies that are able to access capital and continue their growth story. So, very exciting times for them, but still a lot of hurdles to get over here. This isn't happening right now. It's starting to happen, and pocketbooks are being loosened a little bit. Investors are getting more interested in small cap. But monetary policy has to continue to support that, and by that I mean it needs to continue to see rates down, preferably not even flat, but continue to come down, to support the growth. And we can talk a little bit about what a Goldilocks economy is too, because it's critically important for the small caps, and that the monetary policy is favorable. It's getting, getting benefits, getting lower, but at the same time, it's not getting lower because the economy is tanking, right? You have to have a balance where the economy is doing well enough, but interest rates are still coming down. That's the perfect combination for small cap.
All great, and certainly a valid observation, Shawn. Your reports note that small caps are trading at significant discounts to large caps despite higher projected earnings growth. What does this valuation gap tell us about potential upside, and where should investors focus their attention, since we've already established this is not a sector where you do across-the-board bets?
Right, and small cap generally has greater risk, right? So you are going to get a discount to that, but generally have higher growth. So much higher growth than larger cap companies, and those have to balance each other in this kind of environment. And I think the valuation gap improves here, because if this is the Goldilocks scenario, earnings growth is going to significantly outperform in the small cap space, meaning your valuation. Your valuations, you should get a better valuation, or a higher PE for high growth companies. So we think that that'll eventually start to reflect in, higher earnings growth, and then the companies, of course, being reflected in the stock price. So you're going to see that coming around. I think also, looking at what earnings growth models are out there, it is reflecting the assumption that the economy stays healthy. Right, so this is very important, especially the domestic economy. So as these valuation gaps, should close, it's a great opportunity for small cap to finally outperform the larger cap companies from a combination of multiple expansion and earnings growth as the market looks ahead for the next couple of years.
Great. You already touched on the Goldilocks environment. So if I come back around full circle, what do you think it will take to maintain a rally in small caps over the next 12 months?
Yeah, it does go back to that Goldilocks environment, because these are economically sensitive companies, right? So for the most part, so you have to have economic data that will continue to support it's to the point where the Fed may continue to lower still, but it's certainly not because we're having an economic collapse. And I think a lot of the data that'll be watched by investors, and again, boiled down to specific companies, right? Specific sectors will be critical here, and we've got to continue to watch that closely, because if it's perceived that the economy is in decline and jobs are struggling, that, in my view, will be a more powerful catalyst to the downside, quite frankly, than the fact that interest rates are going to come down. So that's why we like that Goldilocks environment where economy's hanging in there, interest rates are coming down. That's going to get a sustained rally.
Fair points. I'm going to come back around full circle on capital access before we wrap up, because I think this is so critical given that so many small cap companies, as you aptly pointed out, are generally cash starved and are raising funds quite frequently. So how does capital market access play into things, and why does this matter for the small caps?
Yeah, it's, these are growth companies, right? And growth companies need capital. And for investors, and I think we're all familiar with this in the small cap world, what is the cost of capital for small cap companies? And sometimes it's incredibly high. And I'm sure all investors out there have had experiences where they've been in a small cap stock and the company needed money. And let's just say the deal that was done wasn't always very constructive and beneficial to existing shareholders. So you have these deals that take place that can put a tremendous amount of pressure on a stock over the short term. So if the investors are able to, and the market, I guess, is able to support better, a lower cost of capital for companies and get better deals done, that really creates a great opportunity to broaden the small cap rally down into these companies that people know are going to need money, that are growth companies. So the investor fear of, boy, I like this story, I like the idea, it's got a great growth story to it, but they're going to need cash in 6 months or in 9 months. That's enough to keep you away from away from that stock, right? Because you don't want to step in front of it unless you believe the conditions are good and that you're able to get, these companies are able to access capital at a reasonable price. My view is that it will start to lift those companies in that, let's call it that second tier. We already talked about those high quality companies with earnings and with good balance sheets. If the capital access does come through, and we're seeing that starting to take place a little bit here in what's now the start of the fourth quarter, I think it creates a great secondary rally in some of these, in some of these other names out there that aren't participating initially because of the concerns about capital.
Great. You and I are both in our fourth decade in this business on Wall Street, and we've seen a lot, which leads to this out-of-the-box question that I have on the top of my head, which is historically most small caps are in a constant fundraising mode, as we established. Do you think the current environment is favorable for such companies to perhaps fortify their balance sheets with larger one-time fundraisers, such that they can create a multi-year runway of capital instead of constantly having to go back out and raise funds?
That's a tough one because you see that happen, and sometimes you create zombie companies and they get too much money and they're able to survive longer than they should. I think the rally in the market would take things like we saw going back a couple of years, as we're all familiar with, like in sustainability, for example. You had a gold rush, so to speak, in sustainability, and companies were able to raise massive amounts of funds that many of them are still living off of, quite frankly. So I think it will depend on whether the company is in a sector like today, rare earth elements and nuclear and AI and some of these others are seeing massive upticks. And when that wind catches in the small cap space, which it has, we've seen it across some of these sectors, yeah, there's the opportunity to put some real money in the bank. And you've seen that, especially across rare earth elements and again, some of the other sectors where these companies have been able to do large capital raises for being small companies. And that does give them that long runway. You hope, of course, investors it's not a rising tide floats a lot of things, not just ships, right? So you got to make sure that some of the companies that are raising capital have good sustainable business models. But to your question, yeah, it's working for some of these sectors, and it takes that off the table and makes it really a more fundamental story that investors can get their teeth into, as opposed to going, when are they going to raise capital? I'm going to face, something with the deal down, coming in and the stock's down 25%.
Right. And yet, ironically, if they raise too much cash and don't have a quick use for it, then they become an activist green light special. So it kind of cuts both ways.
Absolutely. Yeah.
So in wrapping things up, Shawn, what's your take on the likelihood we could see several small cap IPOs in the months and quarters ahead, as the window has been relatively closed over the last few years? And I'm particularly thinking about venture capital firms. I'm thinking about PE firms, which it's well documented have thousands of portfolio companies that they've not had a window to IPO them.
Yeah, and I think that's a great question. I think the IPO side, particularly in smaller cap, you're seeing a lot more coming through SPACs. Again, actually, yes, the SPAC word is back and in pretty robust form, actually. Certainly a lot better companies and quality this time around, but a lot of the smaller companies are coming public via SPACs. You've seen some reverse mergers as well. I'm sure, if the environment stays robust, you will see some traditional IPOs coming out in small caps. I mean, we know there's a pent-up demand across PE and VC community, but I think to that point, though, Tim, many of those companies have been in portfolios for a long time now, and they're much bigger. I think we've seen that. You look at the IPOs coming out today; they're multi-billion, $100 billion type IPOs that are coming out, and not really the small cap ones that used to be the land of growth. Growth companies, the IPO, small growth company going public. So I think it's tougher for them to get to the IPO, traditional IPO route, but there's plenty of opportunities in some of these other vehicles like SPACs and reverse mergers to get out there and access the public markets.
Yeah, really, really good point on the SPACs. So thank you, Shawn, for those interesting insights into the dynamic small cap corner of the stock market. Also, a special thanks to the producer and editor of the podcast, Joe Brunetto. Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to access countless small cap equity research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules from Water Tower Research. We will see you next time for another edition of the WTR Small-Cap Spotlight Podcast.
Great. Thanks, Tim.
Thank you, Shawn.